With the drop in financial stability that we are seeing across the world at the moment, the economy is on the forefront of many people's minds. As of current, we are seeing stocks and housing prices drop dramatically, and the Fed is talking about controlling the economy, which has left a lot of people wondering why in the first place. In this video, we are talking about something even more significant, and arguably where it all began. Because in this video, we are going back in time to look at the death of the real economy. Whilst the current economic downturn might seem bad, one has to ask, why are the markets valued so very highly to begin with? Let me explain. When we focus specifically on the US economy, growth since 2010 has been extreme. The graph on screen right now shows the S&P 500, arguably the most comprehensive indicator of economic performance in America. And when looking at this graph, one thing is very clear. Even when adjusted for inflation, the rise that we are seeing since 2009 has been extremely large and stands out significantly against the market's historical performance. Well, there's nothing wrong with that, you might think. The economy has been strong with the rise of big tech and other innovations, so you would expect the markets to boom. Whilst this may arguably be true, there's a lot more to this than what meets the eye. Because things really haven't been all too natural since the great credit crunch of 2008. Enter the Fed. The first time many of us started to think about the control that the Fed has was back in 2020, because this was the year that the world was forced to shut down, and the United States Federal Reserve decided to print trillions of dollars to make up for shortfallings. This money printing was extreme, so much so that estimates say that up to 40% of all United States dollars ever printed were produced in 2020 alone. This is clearly going to have a massive effect on the economy, artificially altering the USD and the subsequent economy. You could argue that money printing in 2020 was fair. Whilst controversial, you might think that the Fed was doing what they had to do at the time to let people get by in an unprecedented hard time. And although some people may be reluctant to agree, one could not disagree that this is a fair view to hold, and 2020 was rather unfortunate. But what if I told you that this interference goes way back before the pandemic, all the way back to 2008? As we know, the Fed have the ultimate control over the monetary policy, and their decisions directly affect the economy. And the Fed knows this. But the route they have taken, particularly since the financial crisis, may lead you to question the exact system as a whole. Because the process known as money printing, aka quantitative easing, isn't new to the Fed at all. As a matter of fact, they've been doing so since the financial crash back in the late 2000s. And at this point you may be thinking, this should have resulted in catastrophic inflation by now, and you would be correct. But ultimately, the Fed controls everything, but only to a point. Now this channel isn't dedicated to talking about the intricacies of finance, so let's make it very simple. Think about it like a balance. Obviously, you don't want to tip the system off balance, and therefore the Fed must alter other elements of money policy when it comes to keeping things balanced in terms of monetary printing. For this reason, the Fed is currently talking about quantitative tightening in response to the easing which has been taking place since the pandemic. But there is a point where this balance becomes unsustainable, and you could argue that this point has been met since the pandemic, as that was arguably the straw that broke the camel's back, and why we are seeing inflation rise so significantly over the past year. But the question should be, where is this going on a much wider level? Because one clearly understands that money can't be printed forever, as this both undermines and devalues the dollar and the economy. But things have already gotten to a point. Hopefully at this point, you can see the correlation between the money printing and other Fed policies and the increase in the economy that we've been seeing in recent years since the financial crisis, and how policies have rallied stocks for years. But again, this is on false pretenses driven by the Fed's policies. And to cut a very long story short, this is why we are in the current mess. The very reason that the Fed is talking about quantitative tightening in the first place is because of the extreme printing of the dollar. But at this point the question is, can this even be fixed? I have to say that I am no expert, but looking at this, when 40% of the currency has been printed in the last 2 or 3 years alone, you have to ask yourself if things are a little bit off balance. And the reality of this is that to rectify the problem, printed money will have to be removed from the economy, and this is called quantitative tightening. The real issue with this comes at the expense of all of our lifestyles, as the physical amount of money available to all of us will shrink. But hopefully now you see the massive influence that Fed policy has had in altering the markets and pumping things to an insane level, arguably overvaluing everything, and now you see why we are all paying the price. So thank you so much for watching this video. I hope you did enjoy. If you did, of course make sure to subscribe, as we upload videos like this every single week, and there's already loads to watch back on our channel. Just before we do end the video though, I must disclose that I am not an expert, and topics covered in this video are covered to the best of my knowledge. For this reason, if I got anything wrong, I'd love for you to let me know in the comments. But for now it's goodbye. I'd love to see you in the next video, so hopefully you'll join us in the next week. I'll see you all again, goodbye.